We have entered troubled economic times. Inflation is high, energy prices are very high, there are tensions on employment, and of course the stock market and the crypto markets are in free fall. Geopolitical tensions are still running high too. Is it a good time to invest? And how do you even get started? Based on research and my own experience as an investor, we'll summarize all of this and come up with a 5-step guide for you to get started. But first, please click the like button for the YouTube algorithm. It will help us a lot. Thank you, and let's get started. Hello everyone, I'm Johan from Economia, your destination for financial independence, tips to invest and spend wisely. The economic indicators are not good. The GDP for Q2 was minus 0.6% for the US, just 0.6%, positive 0.6% for the Eurozone. Japan was at 2.2% and Singapore at plus 4.4%. If we're looking at inflation, we are setting records in the wrong direction. The US was at 8.3%, a little bit better than the previous quarter. Europe was at 9.1%, Japan at 2.7%, and Singapore at plus 7%. This is quite high. The main market indexes are also down. The S&P 500 is minus 19%, the Nasdaq is minus 28%, Tokyo is down 6%, the FTSE is down 21%, Hong Kong down 19%, Singapore down 20%. And it gets worse. If you look at the crypto market, the Bitcoin is minus 58% for the year. It's really bad. Ethereum, minus 19%. Cardano does a little bit better, minus 6%, but Solana is minus 80%. This is not good for investors, is it? So, is it really a good time to get started investing? It is always a good time to start investing responsibly. First, remember, I'm not a financial investor. I'm just a guy on YouTube. So you should do your own research before doing any investment. That being said, what I'm going to talk about is based on the research I've done, what I've read about others, and what I'm doing myself. Again, this is not financial advice. The first thing you need to do is to put your finances in order. By that I mean covering your basic expenses that I'm listing here with your income or the benefits you're getting. Once you've done that, you make sure that you have cleared any high interest debt, credit card debt, consumer debt, so you have normal and regular expenses. Then you need to fund your emergency fund. An emergency fund is money you pay aside and you do not touch that covers 6 to 9 months of regular expenses. In case something happens to you, you lose your job or you need to take care of a loved one. This will give you a cushion to recover and return to earning an income. And once you've done that, if you have surplus, meaning you have leftover money after covering your expenses, then that's when you can start investing. But how do you get a surplus? Well, you basically optimize your income and your expenses. By that I mean you reduce your expenses, all the frivolous things, all the things you're overspending on, you keep them in check and you increase your income by being better at your job, taking a new job, investing in yourself and being better and earning more money. That's how you optimize everything. Once you have done that and you have money left over, it's time to invest this money. How do you invest this money? Well, first what you have to think about it is invest this money so it produces more money. That's what is called a wealth machine. And actually this term wealth machine comes from someone called Keith Ang, sorry for the pronunciation, at Investment Modes, and I'm going to link down below. The wealth machine, as you can see on the screen, is basically a principle of using your money, your extra money to invest, and this investment keeps growing as you invest every month and produces income, maybe some earnings, maybe some dividends, and progressively those dividends, this money you're buying, is going to progressively create more cash flow being reinvested, and this cash flow progressively will cover your expenses and actually set you free from regular income. That's a very interesting concept that I actually developed in another video that I'm linking here. So the first one, really investing regularly to feed your wealth machine. The second one, really important, is to start investing early so you can benefit from a law that's called the law of compounding interest. The more you invest, the more money is invested, and it keeps rolling like a snowball, if you will. And that's really interesting because if you start investing, say, $400 a month when you're 25, by the time you're 65, 40 years later, you have a very big chance of having $1 million set aside. If you were starting at 35, just 10 years later, you would end up at 65 with only $475,000. That's a big difference. Hence, starting early is really important. But even if you miss starting early for any reason, income reason, studying reason, any reason, that's okay. It's never too late to start investing. The point is, you need to get started. And as our point today, you would be starting investing, if you haven't already, starting investing in a recession. Is it a good idea? Well, actually, it's a big chance. You end up starting to invest when the assets you're investing into are cheaper than usual, making you more likely to get appreciation in value when the economic cycle recovers and goes back up. And what kind of things you should invest in. Don't try timing the market or stock picking. We should take the advice from the best investors. And one of the best investors of our time is obviously Warren Buffett of Berkshire Hathaway. And what he says, you can see it here on screen. He says that most of the investors should always buy low-fee index funds because they cover the whole market and over time they perform better than hedge funds and stock pickers. So that's a really, really good advice we should follow for starters. So we've decided to invest. So now is the first step of our 5-step guide to investing. Step number 1, employee investment plans. How it works is basically if you're working for a fairly big company, they're gonna offer some kind of variation of it. You invest a defined amount of money every month and the company is gonna match the exact same amount for you every month. So basically they are doubling your investment every month. It's a really good deal and it has very favorable tax treatment. So this is a no-brainer, a great way to work. In the US, it's called the 401k. In Japan, it's called the defined contribution plan, and you've heard about that. In the US, the maximum amount you can put every year is $20,500. In Japan, depending on the situation, it's going to be 330,000 Japanese yen. If your company in Japan doesn't offer that, you can do it as a person, as an individual, even though you're employed, and it's called iDeco, and it's worked the same way, and you can contribute different amount depending of your situation. I'll put the amounts here for you. I personally have one of those. Those are really good. There's another one related to your employer, and it's called the ESPP, or Employee Stock Purchase Plan, by which you can buy your company stock at a favorable price every month or every quarter. It's a good way if you're in a company that's growing, which has a stock price that's going up and long-term profitability, and you really believe in it. That's a good way to invest as well, as long as you don't put all your eggs in the same basket and you keep diversifying. Step 2 are retirement accounts. In the US, they're well known. They would be called the IRA, Individual Retirement Account. That is a tax-deferred treatment, or Roth IRA. It's a bit better and has tax-free withdrawal as well. Read the fine prints, but they're up in there. And if you have this money left after your investment with your employers, those are really, really good investments you should look at. Additionally, in Japan, there's now a new one called Nissa. Actually, it's been around for a couple of years. Nissa, or Nippon Investment Saving Account, Nippon, Japan saving accounts. You can have one per person, and basically you can invest up to 1.2 million yen a year for 5 years, so up to 6 million yen, and everything that you invest inside this account, actually all the capital gains as well as the dividends you're getting are tax-free. But it's for 5 years, and after 5 years you have to go for a new one until the law changes. Step number 3, brokerage account. Before starting, I have to make a little parenthesis for viewers from Singapore. In Singapore, you have the CPF, and you have an obligation of course, to put money in the CPF and all the forms and the sub-accounts in the CPF. You're lucky you have your investment needs taken care of already. And once you go over that and you still have money and you want to go to a brokerage account, well, as far as I remember, you guys have 0% capital gain tax. So you're very lucky. You can go with the stock brokerage account and basically invest for free. Really good. So here you go. Stock brokerage account is really good for you in Singapore once you've done everything with the CPF. For everybody else, stock brokerage accounts are also good, but you will be taxed on dividend income and capital gain tax, depending on where you live. But if you have extra money, you don't want to leave it in the bank account, and that's a good way to have it invested. So what do you invest in once you have opened your brokerage account with your bank or online brokerages? Oh, by the way, my favorite brokerage and the one that I use is actually Interactive Brokers. Out of the US, available in Singapore, available in Japan, and a lot of different countries. Hong Kong, I know, and Europe. So that's my favorite, but you can have a lot of different ones online. That being said, what do you invest in? It's gonna be particularly boring what I'm gonna say, but no stock picking. It just doesn't beat the market. It's not me saying it, it's Warren Buffett or Ray Dalio are saying that. The best way for most investors is to buy broad index based investment funds, index funds, or ETFs, and very broad. So you index funds, the SP 500, the Nasdaq, the STI, depending where, and they cover the market. Maybe you want just the S&P 500 rather than having the whole US or a world fund or Asia fund, Europe fund. You decide. Maybe it's not just the geography. You want to go for technology. You want to go for dividend, for REITs. That's up to you. Or commodities. That's up to you. But try to diversify, max 3 to 4, and make sure that they have low fees, because the high fees are gonna immediately eat into your return. Now, fortunately, we have as low as 0% and maximum 1%. 1% starts being very expensive in nowadays. So anything between 0% and 0.8, 0.9% should be a good thing for you to look in terms of fees. And when should you invest? Don't try to time your market. Nobody can time the market. There is this study that I'm putting here on screen. If you miss the best day, the market, your return can go really down really fast. So rather than trying to pick a time to invest, you need to invest regularly, and it's called dollar cost average. Dollar cost average is basically buying the ups, buying the lows, or what Warren Buffett said in one of the quotes is, through the thick and thin. So basically, by buying all the time, you average your cost. Step 4, alternate investment or other investments besides the stock market and everything we talked about. The first one that comes to mind is everything you can do with insurance companies. First, you can insure your own life. If people are depending on you and some unfortunate event may happen, you can leave money behind for your loved ones. So that would be an interesting one. You can also plan for retirement. That could be additional retirement income as a lump sum or as annuities. You can look at that. It can be some plans for education. Maybe you have kids and you want to put money aside for the education in the future, or put money aside for medical emergencies if your country doesn't provide for it, or if you want to provide yourself with extra money for medical emergencies. So that's the kind of work you can do with an insurance company. I have plans. I have all of those plans myself. If you want me to dig a bit deeper into everything that you can do with insurance companies, please leave a comment down below and I'll prepare some content for you and maybe bring someone for an interview in the future. So that's insurance companies. Let's continue real estate. As we see now, the markets are going up and down, are very uncertain. Real estate is something you can invest into. I'm not talking about where you live, though that could be an opportunity, but also rental real estate. You create passive income, passive cash flow, and the value might increase over time. This is very interesting. There are a lot of tax benefit of investing in real estate, whether you do it under your name or under the name of a company like an LCC, like I'm doing, and that's what is being recommended by most tax accountants or tax professionals I've heard of, but it depends on where you live, so you should ask around and take advice from professional. So that's a really interesting way to create additional income, additional cash flow if you have the money to buy directly or leverage money. I know the mortgage rates are going high very fast in the US, and of course the price of real estate is quite high, but it's not the case everywhere. So something you could look at if you don't want to invest in actual real estate but prefer go through a REIT, a real estate investment trust, which is also another financial product to invest in real estate. That's something you can look at, and they provide a lot of revenue through dividend, regular quarterly or monthly dividend, up to you to look at that. Then finally, crypto. Of course, cryptocurrencies. This is another interesting investment. I'm personally a crypto investor, but it's a very, very risky investment. Still it goes up, it goes down a lot. We saw that at the beginning. So no more than 5% of your overall portfolio should be in crypto. I personally invest in Bitcoin, ETH, Cardano, Solana, XRP, but you can look at what you prefer. We have a video about crypto here. You can have a look and see what you want to do. And the rumors has it that Fidelity wants to start offering crypto investments through the 401k that they are actually managing, would open the gates for much more institutional investment that could help maybe the crypto market go back up. But those are only rumors. This is not an advice for you to buy, so look around, but that might be a very good alternative investment as well. That's it. You have all the alternative investment I could think about. There's art, there are a lot of things, there are collectibles, but I'm not versed enough, so do your own research at that. And let's go to step 5. So now we're at step 5. What do we do at step 5? You know what? We rinse and repeat. Yes, that's the 5th step. You continue investing over time. This extra money, whether it's step 1, step 2, step 3, or if you have even more money, step 4, you need to keep investing all the time, dollar cost averaging, and keep invested in the market long time and grow your nest over time so that you get more money. And remember, we had this wealth machine at the beginning. You have it here again. This is the secret of investing, is keeping investing all the time. As I was saying at the beginning, starting to invest in a recession is a chance. You are buying cheaper assets and you have more opportunities for an upside. So as I said, invest responsibly. You follow the 5 steps I've given you before. Have broad-based investment. Make sure you go through index funds or ETFs with low fees. Don't try to time the market. Be responsible, look at it, and look at your wealth grow over time. That's it for today. Thank you so much for watching. Please give this video a like if you like the content. Do not hesitate to subscribe to know when new videos are coming up. And if you have any comment, any ideas for new video, or just want to say hello, please leave a comment below. Thank you again, and until next time, goodbye.